Shyam Srinivasan, the MD and CEO at Federal Bank, now joins us on the show to talk about how the outlook ahead could be like. What they've done in the quarter is well known now because the market has already rewarded that in trade yesterday. Mr. Srinivasan, good having you. Thank you so much for speaking to us at Bloomberg Quint. This is Neeraj here. Good morning. The question mark at the top of the mind of everybody would be that what you've shown in quarter one, which is a fairly stable quarter, will you be able to show that for the next few quarters? And is it possible to predict that right now, or will you have to take it as it comes?
Neeraj, thank you. And see, as always, the story is never about the growth. It's all around the credit quality. And if you sort of go back many quarters, this quarter was no exception in the operating performance or in the credit growth or the overall fundamentals of the bank. The one big sort of impact was in Q4 of last year when, as you know, the slippages went up materially and consequently the outcomes were less than acceptable. This quarter that got reversed, and I had pointed out that was more a one-off impact of 4 large accounts. And the tail of that, I said, will flow through in FY19. A part of it did in Q1. So I believe that the underlying performance for 10 odd quarters has been 20% plus growth, operating profits sequentially growing as it did this quarter. We are quite hopeful that this momentum will continue. We are seeing us gain share all across, both in credit and deposit across many geographies. So the confidence the bank has in terms of underlying performance remains robust. The credit wrinkles, I think, more or less have been addressed. We don't have any large cases in our portfolio that needs specific sort of resolution from outside of the normal bilateral transactions. So I'm hopeful that we will be on guidance for FY19. And we had, like you probably have noted, we had guided for 65-70 basis points of credit cost. And within the year, I said there could be some up and down, but I believe we are on course.
Interesting. So just a couple of follow-ups to that. You believe that the kind of slippages performance that you've shown, I'm just looking at what you did in quarter 4 versus quarter 1, and I agree that that was more or less anticipated, but in absolute numbers as well, would you reckon that the trajectory will not show any material tick upwards over the next 3 quarters?
Yeah, we believe it shouldn't be the case, and I've always said that the only wild card in this is Air India, and it's a large account where we are a very small shareholder, share. So we don't know the outcomes, but my personal view is that it won't become a situation where it'll become an NPA. There's some kind of remediation would come into force. So if you keep that 250 crores out, the restructured standard asset book of the bank is about 550 odd crores. So out of that, 250 crores is one account. Baki 300 crores is really a collection of many small accounts. So they don't have any characteristic of falling away in 1 quarter or so. So I would like to believe that outside of Air India, there shouldn't be any giant cases, which we don't have any, which can come to impact us in the course of FY19.
Interesting. Just one small question out here. This is not with regards to Federal Bank alone, but for a lot of banks which have faced headwinds, some of which were beyond their controls, for the last 12 to 18 odd months, we've been hearing these calls of the worst finally seeming to be behind us. Can we safely say, you've been at this helm, you've nurtured this one, Federal Bank now for a really long time now. Do you get a sense that finally the tough times on slippages or NPL formation, wherein there have been a couple of surprises from your end in the past few quarters, are all of these behind us now safely?
I think the one that most bankers, including me, would see is the formation has come down substantially, as all of us have seen through many banks' numbers, including ours. Surprises, I would believe that surprises are invariably from the outside world, never from the institution itself. Some regulation changes, something in the environment, materially changes. So I'd like to believe the formation of new bad has come down substantially. For many banks who haven't grown over the last 2-3 years in credit, the likelihood of new credit slipping is also coming off considerably. And those of us who have grown smartly have grown in the better credit segment. So I am much more hopeful that the recognition has been well done, and I would think whatever tail of it is happening in this quarter or the next because of the impact of the February 12 circular, the resolution and the financial consequences of the resolution and the recovery, that could be 12, 18 months depending on how each of these big cases play out. Barring the 2-3 large steel cases, the rest are all going through various phases in their resolution process. So I can't comment on the financial outcomes, but I want to believe that the slippages have started coming down. Formation of new bad has come down quite substantially for us for sure, and I would think for the rest of the industry too.
Wow, so no fresh negative surprises on NPL formation as well, I think is one takeaway. A couple of concerns, Mr. Srinivasan, if I can, which the reports seem to contain. One of them is, of course, about the targets that you've given for NIMS at about 3.2, if I'm not wrong, is what you've guided for the year. Now, people believe that primarily, one, due to the rising costs that almost the entire industry will face, as also the rising competitive intensity would make this a slightly difficult task. Would you believe that as well, or would you believe this is a very, very comfortable target for you to reach?
Neeraj, nothing is very comfortable to reach. Everything is an effort.
Sure.
But I want to point out that this 3.12 that we have today is 3.32 that has come down to 3.12. And in part that's impacted by the higher slippages, which means higher interest reversals. So it's not necessarily the 3.12 going to 3.2 for a full year basis. It's really the 3.32 correcting itself to 3.2. So while it is an ambitious outcome, we've set ourselves some stretch goals. Our belief is if we continue to manage our credit slippages well, which is our sort of focus and confidence. Second, our credit CD ratio is in the 84, 85. So keep that going. As you know, we have a remarkable liability franchise, probably the only bank in the country which has 96% retail deposits. So I think the management of our deposit profile, the credit slippages being in control, and some degree of redistribution of the kind of growth between secured, unsecured, between retail, SME, business banking, corporate. So the balancing out should give us that uptick from where we are, but I must point out it's still lower than what we were. Yeah. So our belief is somewhere in the 3.2 is what we are sort of working very hard for. Well, but it's not a slam dunk, it's not easy.
Yeah, it's not easy. Of course, the street believes it's difficult, so I'm sure the street will be very, very happy if you manage to do that by the end of the year. My last question, sir, and that would be one concern, two questions rolled into one. One is that your fee income growth somehow has not been able to keep pace with the loan growth. What do you want to say there? And the IDBI Federal Life deal, I mean, given the LIC takeover of IDBI, how does that go ahead now?
On the second part, which is the question on IDBI Federal, as we speak, I have nothing to add or subtract from, because everything is, we all pick up from what you guys report in the media on LIC's investments in IDBI and the consequences thereof. We don't have any formal process that has stopped the exercise that we commenced, which may come through in the next 2-3 quarters as we get clarity from IDBI on their own future. So at this juncture, I don't have much to answer other than the fact that thankfully IDBI Federal as a company is continuing to do well, and they are sort of unimpacted or not impacted by the developments outside, which therefore as a big shareholder of the company we are pleased with. On your question on fee income, it's kind of up and down, because if you see the other income as the total income that we show beyond interest income has always had either a remarkable benefit because of treasury, or sometimes the treasury yields being where they are, we don't make the same kind of gains, treasury gains. But if you peel it, we will see FX has been growing consistently. Retail fee income is beginning to inch up, not substantially, but beginning to inch up. And the other area of trying to get the corporates whom we have started getting very good relationships to do much more than just credit. So you will see that the credit growth which is north of 22-24%, the fee income will start tracking in the late teens to early 20 very soon, and that's been demonstrated. But the net number invariably has either a treasury gain or a treasury lower profit, which sort of skews that number. That said, I still want to believe that we have a lot of work to do on that count, and there are some specific initiatives to make that come true.